Before we get to Chris, I want to highlight Schaefer's Playbook of the Week, which we talk about on today's episode. It's a weekly interactive educational series put on by our traders here at Schaefer's. It's a live session that you can tune into or download after, 50 minutes or so every Monday, and it features a recap of the prior week, bullish and bearish watch lists, a stock of the week, which we'll get into in great detail today, what to watch in the week ahead, plus a whole bunch of educational musings on options and investing terms. This isn't even part of the ad read. Honestly, this is an awesome product that we've been rolling out. I truly feel lost entering the week without it, and it's done in such a digestible, concise manner. It's got you excited on Monday mornings to start your trading week. It's the perfect tool to begin your options trading journey. And join us next week and realize all the benefits of starting your week with Matt or Chris with a $10 trial to our Playbook of the Week. That's it, $10. Once you see it, you'll love it, and you'll qualify for a discounted membership to Bernie's premier live trading program. Head to the link in this episode's bio or call 1-800-448-2080 to sign up. That's 1-800-448-2080. Now, here's Chris. Welcome back to Schaefer's Market Mashup. Thanks to everybody that listened to last week's solo session. Always a shock when I see people actually want to hear me and only me. Thankfully, we're done with that. We've got Senior Market Strategist Chris Prybal back on for a long overdue chop session. Chris, how you been?
Welcome back, everyone. I've been good.
Great. We've got a whole bunch of stuff to get into. We've got our eyes on a whole lot of things. But first, as you've just heard in the ad read, very excited about our Playbook of the Week that we've been doing every Monday. We have a deal running right now. I think it's $10 trial. And Chris is fresh off was this your first playbook?
This was my first ever. Yeah, it was an exciting process. Glad I did it. I mean, it's good preparation for the week, and any investor or option trader, it's a great segue into a new week.
Yeah, I love it. And I like transcribing it and reposting the stock of the week out on our website. So your most recent one is a bullish play. The stock of the week is Toast, ticker TOST. You mentioned the Golden Cross, and I'll let you explain that. Was that what first drew you to Toast, or was it something else?
I found Toast on a screen searching for stocks within a certain percentage of their 200-day moving average. That was the first time that the ticker came across my screen. And what I realized and what I liked about that is that since Toast's IPO, they had been trading lower. So this was the first time ever that Toast was above the 200-day, which, I mean, it seems sensical because the stock had sold off from their IPO. But you look back at every chart that you pull up, and there's times that they're above and below the 200-day, and it just struck me as odd that here's something, that people obviously like. It's a useful product, and it's just been sold ever since the IPO. And once it crossed that 200-day, and then the subsequent Golden Cross, where the 50-day caught up and it crossed that 200-day, it was just like a cherry on top of the sundae.
Mm-hmm. I guess, would you call 200-day a longer term?
Most people that are investors would. If you're a day trader, it's definitely longer term. If you're trading the market short term, I doubt you're paying attention to the 200-day. It's just too slow for what they do.
Mm-hmm. And then you just dug deeper from there. But what other contrarian factors did you see there?
The 200-day, just going back to your previous point, is often a demarcation point for a stock or an equity. You'll pull back to that level and they either bounce, or you'll break through that level and you'll continue to accelerate the selling to the downside. So it's just one of those Mendoza lines, like in baseball. You get your 200 average, you want to be above that line. It's just one of those psychological indicators more than anything. In addition to the technicals there, Toast IPO'd at 40 a share. So the 20 a share was half that high or half that IPO level. And it had acted as support recently too, in addition to the 200 days. So you actually had the 200 day, the 100 day, and then you had the half of the IPO on a short-term upsloping chart. You do run the risk that this is a technology company and the Fed's going to raise interest rates, and it's very difficult for software companies that don't generate much profit right now to be sustained in a rising interest rate environment because their financing costs are going up and they're not making any money currently. So it's a difficult pickle to be in.
I should note that it's Wednesday, November 2nd. We're a couple hours away from Powell speaking and the likely 75 basis point interest rate hike there.
Toast had some. I like to look at 6-month relative performance to the S&P 500 just as a indicator of whether the stock's been strong or weak in the 6-month time frame. And Toast had gone positive over the 6-month period. And when I put on this trade, it had a 6-month gain of 15% versus a negative 6% for the SPY at the time. So it was outperforming in a turbulent market. Subsequently, in August, they reported earnings. They beat on revenue, they beat on earnings, and they raised their guidance. So you're coming off of a fundamentally strong picture. You've got a technically improving landscape. And then from the sentiment side, short interest had been rising alongside this bullish base, this pivot we're on. And the shorts are riding it up. And they had increased, the short position was up 35% over the past month. So there is a contingent of investors that are short in the stock. And if they get tired of losing, if Toast continues to rally, they're going to have to cover. And we've all seen the short covering rally, and I'm sure you've covered it in many of these pods, how tenacious that rally can be when you get the rush to the exit for the short seller.
Very well put. Yeah, there's a lot to like about that. A stock in that matter that you see in your day-to-day life, the applications. You're going to a restaurant, you're seeing the Toast app there. And so there's some real world applications there that make that an exciting trade.
Not only do you see the Toast app and the hardware, but you realize that it streamlines the entire process for the restaurant and for the customer. Mm-hmm. You don't have that middle person that's scratching down on a notepad what you had ordered. And there's no passing that order to the cook, via talking, and whether or not they're comprehending what the server is saying. It's all automated. Mm-hmm. So your chance of error drops considerably, and the time that you can fulfill this order increases. It's a win-win.
Did you ever work in the restaurant industry?
I started out, in the food service industry when I was younger. It was at a golf course, Sharon Woods here in Ohio, so it was rather laid back. It wasn't as pushy as, a fast food at McDonald's or Taco Bell. So it wasn't that bad. How about yourself?
No, I did like the front desk or the front food court for a golf course at Avon Fields.
Oh, yeah.
But there wasn't any actual cooking, and it was just throw a hot dog on the grill or anything like that. I didn't have any kind of assembly line stuff going on. Nothing like for the Hulu show, The Bear, which has been my favorite show of the year so far. Nothing like that where you're in a restaurant and you're part of an ecosystem there.
Yeah, when you have a kitchen and a staff and there's people moving around left and right, I mean, it's very hectic, especially during, the peak work hours, the dinner rush. And anything you can do to streamline that and make it easier for the restaurant, it makes a more successful restaurant.
For sure.
And I actually I had the time to look over their corporate presentation from the past month. Their Toast it does a real good job of, if you go to their website, you can get a monthly presentation that they presented to the analyst. And on top of the three base products that they have, the point of sale, the hardware, and then the payment processing end, they've got elective products that they're adding in addition to this, like an online ordering. They'll take care of your payroll. They'll take care of your scheduling. They've got a capital component, so they can finance. If you want to grow your business, they can finance you. So they're branching out off of this main product in a lot of different, gift cards, email marketing, all kinds of analytics that the restaurant owner gets to see, from time to product orders. It's very detailed, and I don't own a restaurant personally, but if I did, I would use the Toast platform personally.
Wow. Yeah, no, we like all of that transparency, and there's a lot of ways that you can benefit from that. Ticker TOST, that's definitely one to watch. Pivoting a little bit, I wrote all about lithium mining and the stocks in that sector. I won't repeat much of that, but I have been looking at EVs a lot. For the first time in 8 years, I'm finally in the market for a car and doing deep dives into the technology behind them, and lithium mining and the microchips and the semiconductors. I saw Livent today, ticker LTHM, slashed its full year guidance. What do you have to add, and what are your thoughts on the EV sector, the lithium mining, or anything adjacent to it?
I don't know if you saw my email this morning. I put together the five main lithium stocks, and I looked at their buy to open option activity, and it's apparent from that chart that there are a lot of call speculators chasing this trade already. With the pullback today in most of the stocks, you're finding a little technical sell-off, but it appears within a general uptrend. It's not as if they're creating a new downtrend. It's just a pullback within an uptrend. You've got skepticism on several of these players still. I mean, even though they might be call heavy, those options are going to expire. Most people are trading short-term options these days, so they could expire a week from now, and you could remove that headwind. But from an analyst point of view, I'm looking at Albemarle. It has as many hold ratings as it has sells. Lithium, Livent that you just said, it has about twice as many hold sells as it has buys. And then the other ones are not as slanted, but I'm just trying to dissect the different levels of sentiment. Tesla is your leader. So you got all the airplay there. But it's just a matter of, if we're going to ramp up production at such a high pace, there's got to be battery players that step up and serve the market, since Biden has stated that if you want to build an electric vehicle in America, it has to use 75% components have to be derived from our continent. Mm-hmm. So who is going to manufacture all those parts if it's not a Chinese company?
Yeah, the supply and demand side of it all is very exciting, especially from a longer term perspective, because this isn't some trend or fad. This is something that's going to be a fabric of our transportation and infrastructure for a very long time.
Yeah, we don't really have another choice from a climate point of view. I look forward to the advancement of lithium batteries serving the diesel engine industry. Mm-hmm. I don't know how many times I pull up next to a Duke Energy contractor or a Waterworks contractor or any contractor that you see on the street, and these guys will have their trucks running, and they're not even in the truck. They're out 50 yards away having a meeting with some other people, and they just leave their truck running. And I'm like, do you not read the news? Do you not realize what's going on across the globe? I understand for a police officer or an ambulance to leave their truck running because they need to get in and go immediately. But for a contract worker or a utility worker to leave their truck on unattended, it's sickening, really. I mean, I want to yell at the person, but I'm too nice of a person to approach them. But man, we all got to do a better job of reducing our carbon footprint. And this is one step that the government is saying, we need to speed up this process.
Mm-hmm. And it's definitely a technology that is right now it costs a lot, and there's, the company's margins are difficult because it's still in its infancy. But in 3 or 4 years, if there's some technology that's developed that streamlines it, that makes it easier, it really does feel like what I think the New York Times article called it is the white gold rush.
Yeah, they'll have the ability to scale up.
That's the word I was looking for. This is a scalable technology with supply and demand, and only going to get more feasible.
And it leads you back to the lithium ion battery, because you can't have the electric car without this battery.
A little adjacent to what you were talking about as far as, your carbon footprint. I did, World Cup's coming up. You and I are big golfers. We've been embroiled in the live drama for the last year now. It's something I've been meaning to talk about on these podcasts. Given our line of work, the relationship between ethics and investing, whether you think of oil companies and the fracking and the exploration there, or even something as simple as Coca-Cola, one of FIFA's big sponsors, and FIFA in league with Qatar, or a company like Callaway. Although I know that a lot of companies are dropping their sponsorship of Live and the Saudi Arabia stuff. But how do you rectify that? How do you balance that between being an investor and then also trying to have this ethical code?
It's difficult because the Live situation is so sensitive and delicate. And I see your point about the oil industry, and you want to clean up this planet. Obviously, there's going to be a profit motive. Anytime you run a business, don't you want to run that business for a profit? Isn't that the point of a business model? Is that to extract money?
But what I'm wondering is, as an investor or as someone interested in making money, do you have second thoughts about, buying a call option on Marathon Oil or something along those lines?
You do.
Yeah.
It's crossed my mind. Mm-hmm. Do I want to participate in what they're doing, whether I like it or not? At the end of the day, there are only so many opportunities in the marketplace. Mm-hmm. And if you're going to let your political or environmental whims or thoughts lead or be your strategic weapon in the stock market, I don't think you're going to have very good results, because you're excluding a sector or an industry or a component of the market just based off of, I don't like the way they do business, so I'm not going to invest with them. So if you say that about oil companies, I'm sure you could say that about the banks. Mm-hmm. I'm sure you could say that about some industrial companies. I'm sure that you could say that about the utility companies. I mean, if you go sector by sector and say, I don't like the way they're doing business, or I don't like the way they're running, you're going to be left with 2 or 3 sectors to invest in.
That's a good point.
I mean, it's a broad market.
You
can't let your emotions or your global logic supersede an investment opportunity. It's like going to the casino and you go to the roulette wheel and you're looking at all the numbers and you're like, well, I don't really like the color red, so I'm just going to play black and green. Mm-hmm. Good luck with that.
I definitely think you have to check a lot of your, political, social capital at the door if your interest is solely to make money, especially if you're an investor, especially if you're an options trader. Like you said, your percentages go way down if you hold that your core values close. Now I think this will become a fascinating thing in the next 15 to 20 years, is how that becomes balanced, because you have company, the corporate social responsibility, but then how much of that is bullshit. I think it's
I think we're seeing it play out right now before these elections. There's a lot of pension funds that are removing any oil investments from their strategy, from their overall portfolio.
Mm-hmm.
They're just saying we don't want these companies in our portfolio anymore. And whether they're going to BlackRock or whether they're going to whatever hedge fund manager, they're just saying, I want all this removed. I mean, I see it every week where there's a certain group where they're done with fossil fuel investments. They don't want those representing their portfolio going forward. So there is a movement going on currently that kind of dovetails with what you just brought up.
There won't be a paradigm shift, but it's such a nuanced subject that I think there will be slight adjustments here and there, especially depending on what the macro outlook is. Like you said, we are facing a lot of global crises, and if these get exacerbated, then it's definitely something, if the situation stinks so much, you really have to tweak your investment thesis. But that's something that was always on my mind as not an investor, strictly just as someone in either journal, whatever you want to call my field, picking the brain of someone who is focused on making money. But we have about 10 minutes here. I did want to hop away from that since both of us definitely got on our soapboxes there, and then just do some quick hitters around the market about any sectors and stocks that you're keeping an eye on as we close out the year. I know you mentioned the electrical grid companies. I saw when we did our best and worst of November that a bunch of them, let me find the tickers, FE, ED, EXC, SO, DTE, all historically underperformed in November. I didn't know if there was any kind of connection there or what was the connective tissue. But yeah, long story short, what do you got your eye on as we, close out 2022?
Well, I'm focused on the Fed today. I know there's 88% probability that we'll get the 3/4, the 75% increase. And then I went out to the CME FedWatch tool before we got on here, and I looked out to December. And right now, if you assume the 75 this afternoon, there's about a 50-50 chance that we'll either get a 50% or another 75% interest rate rise in December, in addition to the 75 today. So you're looking at, by February of 2023, the highest probability that the market is pricing is that interest rates will be 100% higher than they are now by February. So 4 months from now, expect interest rates to be 1 full percentage point higher. That's what the market is pricing in. That's not me.
Mm-hmm.
So that's what we're staring at going into the seasonally strong end of the year. And you got to remember, Fed is looking at employment and they're looking at wages. And neither one of those indicators have shown any signs of stopping their unbelievable run. I mean, wages continue to rise and employment continues to be very low. And
right, there were some numbers that came out today I saw just briefly that were incredibly strong.
And the Fed has to keep their foot on the brake. They have to maintain some discipline. They have to raise rates no matter what people dream or want or wish. They've got a job to do. They've got to lower this interest rate, or lower the inflation rate. And I know people say, well, inflation, there's already signs of it turning over. And it's like, so you're going to tell the Fed to just guess, use a guesstimate. Well, it's supposed to go down in the future. So let's take that. They're looking at hard data from the past month and the past quarter. And when they look at that data, they don't really have a choice. They've got to slow down the train. I mean, if you aren't prepared for that, you're still living in that zero interest rate wacky world where anything can go up in value. If you got a good business idea, oh yeah, that's $10 billion valuation. It's like, well, what were their sales last year? And you come to find out it was only 150,000 in sales and they're worth $10 billion. And you scratch your head and you say, what? Why? Why would a company that has minimal revenue be valued at such a high level? And I think the Fed is doing a good job of bringing the market back into a valuation metric. I looked, the S&P's about 16 or 17 times the past year's earnings, which anytime you get above 20, that's usually you're expensive. Anytime you get below 15, that's usually a good buy. So we're kind of still in that little sweet spot that the Fed can push the market lower, and we're not really on sale. There's a discount on stocks right now for sure. Everyone likes a sale, but they're not really rock bottom prices yet.
Yeah, it's not silly season.
And you're not at those long-term moving averages like the 500-day or the 1,000-day.
Mm-hmm.
Those have historically been the best times to pounce. We're not there yet. We're in a short-term bullish bounce in an intermediate and long-term downtrend.
Mm-hmm.
And the Fed's going to keep that up. I'm telling you, they don't have a choice.
Yeah. Love looking at those long-term averages. I think it really crystallizes a lot of things.
It puts everything in context.
Mm-hmm.
Another thing I'm doing right now is the 3-year relative strength look back. And I look at the 3-year because it encompasses the before COVID, during COVID, and after COVID. So you can see how this stock reacted throughout those different environments. And it's just fascinating to me to see a stock that's below their COVID lows. And you ask yourself, wow, that's not good. Think about that. And you find stocks that are at their COVID lows and analysts love them. And people are buying calls left and right, expecting this big bounce. Why is the stock at COVID lows in the first place? Maybe it's a shitty investment. Why would it not have gone up through that entire COVID period where the government flooded everyone's bank account with money? And your stock can't go up during that? So that's where the 3-year look back and relative strength, that's one of my flavors of the week. That's the shiny object for me.
Yeah, that's great, and definitely something tangible to latch onto and chew on if you're a listener. Chris, as we wrap up here, first of all, I found a nickname for you. I'm not sure how deep into baseball you are, but I remember this guy was a big fantasy baseball guy back when I was playing in high school and everything. You are Chone Figgins. Because it's a utility man. He can play any position. He can talk about anything. Like we talked about this before we aired. You got your hand in all sorts of different areas, and that's why we love having you on, because you can really shed light on any sort of topic.
Well, with that being said, I wanted to remind you about the copper. Dr. Copper, we talked about the 50% Fibonacci retracement from the COVID low to the COVID high.
Mm-hmm.
We have traded at 350 for 4 months straight.
Woo!
4 months straight, right at that 50% level of that range. So that pretty much tells you that there's a lot of indecision out there, and people do not know if we're going to go lower or we're going to go higher. But I tell you, when the Fed makes that decision later on today, we're probably going to find out.
Yeah.
I'm excited for it.
I love it. Chris, thanks for coming on again, man. You are just a wealth of knowledge here, and you, yeah, it's honestly, we can keep going for an hour, but let's cut it here. Anything else anything else you'd like to say and wrap up and finish with?
Hopefully the audience got a lot out of this pod, and if you guys have questions, please send them in. We'll focus on them in the next pod, or I'll single-handedly email you a response to your questions. So send them in.
For sure. I'll put the emails in the episode bio so you guys can reach us pretty easily. All right. Cheers, Chris.
Thanks, Patrick.